In this video, we're going to look at Johnson & Johnson, ticker symbol JNJ, the pros and cons to the stock, what it would be worth if you invested 10 and 20 years ago, hypothetically what it could be worth 10 years from now. Also, I briefly talk about the spin-off Kenvue, one of its subsidiaries, also what the forecasted price targets are from analysts. My name is Alex, and this is my dividend income channel. So let's start with the pros and cons. Number one, it's an established brand. Johnson & Johnson is a well-known and reputable brand that has been around for over 130 years, which can provide a sense of stability and trustworthiness to potential investors. Number two, diverse portfolio. Johnson & Johnson has a diverse portfolio of products, including pharmaceuticals, medical devices, and consumer health products, which can help mitigate risks associated with fluctuations in any one particular market. Number three, strong financials. Johnson & Johnson has consistently reported strong financials, including solid revenue and earnings growth, as well as a healthy balance sheet with low debt to equity ratio. Number four, dividend payout. Johnson & Johnson is known for paying out a consistent and reliable dividend, making it an attractive option for investors seeking steady income. It is a dividend king due to its long history of consistently increasing its dividend payout. In fact, it's done this for the last 59 years, which is one of the longest streaks of dividend increases among all publicly traded companies. Then let's have a look at the cons. Number one, legal issues. Johnson & Johnson has faced several lawsuits and regulatory actions in recent years, including lawsuits related to the talc-based baby powder and lawsuits related to its opioid products. These legal issues can lead to reputational damage and financial penalties. Number two, patent expirations. Like other pharmaceutical companies, Johnson & Johnson face the risk of patent expirations for its key products, which can lead to revenue declines and increased competition from generic alternatives. Number three, competition. Johnson & Johnson operates in a highly competitive market, with many other established companies vying for market share in the same industries. They can make it challenging for the company to maintain its market position and grow its revenues. Number four, economic downturns. Johnson & Johnson's revenue is highly dependent on consumer spending, which can be negatively impacted by economic downturns. In such situations, consumers may cut back on spending on non-essential items such as consumer health products. Now on to the spin-off. City Index have a great article breaking down the spin-off and what it means for investors. I have left the link to the article in the description beneath the video. J&J is expected to spin off its consumer arm, most commonly known for plasters, baby shampoo and the Listerine brand of mouthwash. This marks the largest restructuring in the company's 135-year history. The new company will be called Kenvue. The split is aimed at refocusing the business and streamlining its operations. By removing the consumer arm, J&J will put more into developing the medicines and medical devices, which brought in around $80 billion for the firm combined. The medical arm had disappointing sales after the competitors' COVID-19 vaccinations were more successful, but it still has a higher growth outlook. The spin-off shouldn't fundamentally change the operations of either business. So now what happens with the stock? Once the stock splits, J&J will only give traders and investors exposure to the medical device and pharmaceutical proceeds of the company. The new company will be listed as Kenvue, which will trade separately. The split is expected to make more shareholder returns as each business won't be diluted by the others. Investors will have a clear image of each division and what makes it attractive. A possible downside after the split is the shares might not be such a bold defensive play as the company won't be as diversified. The sheer scale of the operations has somewhat protected the stock from volatility, and breaking that up could have a negative impact on the company's stability. What does the split mean for shareholders? If you currently own shares of Johnson & Johnson, when the company splits, you will own both shares of Johnson & Johnson and the new company, Kenvue. The spin-off should happen later this year in November. I own shares in Johnson & Johnson, so it'll be interesting to see how this plays out. As long as Kenvue pays dividends, I will keep on holding it and see how the company performs. Now let's have a look at how the stock has performed over the last few years. If you invested $10,000 in Johnson & Johnson stock 10 years ago, what would it be worth today? If we purchased $10,000 on May 2nd, 2013, you would have been able to buy approximately 122 shares at the closing price of $81.63. Then as of May 2nd, 2023, assuming you did not reinvest any dividends, the value of the investment would have been approximately $19,950 based on the closing price of $163.60 per share. If you had reinvested the dividends received over the past 10 years, it would have further increased the value of your investment. The average dividend yield over the last 10 years was approximately 2.5%. If these were reinvested, you would have added approximately $2,807 to your investment. This would mean it would be now worth $22,757. Now, what if we go back a further 20 years? If you'd invested $10,000 on May 2nd, 2003, you could have approximately bought 163 shares at the closing price of $61.46. Then as of May 2nd, assuming you did not reinvest any dividends, the value of your investment would be approximately $26,742. Now, if you'd reinvested those dividends, it would be worth approximately $46,547. It's important to remember that past performance does not guarantee future results, and the value of your investment can fluctuate over time. We cannot predict the future, but if we hypothesize and make an informed decision, if we purchase $10,000 today, what would that be worth in 2033? If we bought it at $164 a share, and the stock price continues at a rate of approximately 6% per year, similar to the average annual return for the last 10 years, and Johnson & Johnson continues to increase its dividends, your investment could potentially be worth $20,958 in 2033, so doubling your initial investment. This is looking at the long term, but what do analysts think about the 12-month forecast of the stock price? CNN Business have an average buy price of $177, 8.4% upside from where we are today, based on 19 analysts. Tip Ranks have an average buy price of $179.95, 10.14% upside from where we are today. And Zacks have an average buy price of $183.31, 11.98% upside from where we are today. The stock price had dropped into the 150s with the talc lawsuit looming over them like a black cloud, but now that has settled, it has begun to rise. Personally, I've been buying every month in the low 160s, slowly building my position. I'm hoping it stays in this range for the next few months. It did hit 180 in January this year and June last year. I'm buying these prolonged dips when I can. As usual, thanks for watching. If you enjoyed the video, please like and subscribe.